Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. Holiday week. It should be a fairly quiet week in general for markets right now. We're looking at a 10-year yield just inside of 450. I will say it feels a lot better at 450 than the potential to be at 550. So it always takes a catalyst. We know these markets. The catalyst this time around, clearly the data side of the equation. It felt really bad at 5%, a little above 5%. Positions always come into play as well. But in and around these levels, if we go back and look at this journey from 2020 to where we are today, it's really still a bear market correction that we're looking at right now. And the waves higher in yield over that time period have typically come in around 175 to 200 basis points, and then we've corrected back the other way. If you look at the 200-day moving average, there's still room below here in terms of the lower rate story locally for this market to still maintain its bearish stance. So for now, we're treating this as a bear market correction with a lot of Treasury debt to roll over next year and a lot of new issuance in the market as well. Inflation. We talk a lot about the trajectory of inflation. We talked a lot about that to start this year. It's more of a grind from here. If you look at some of the structural issues that are in the economy right now, the global economy, we still believe inflation to a certain extent will be on the Fed's mind going forward. The disinflation story is strong, but certainly from here, even the CPI numbers that we've seen, it's likely to be more of a grind than anything else. The other thing too that we don't really talk a lot about is the overall level of inflation. So yes, the rate of change has slowed, which is constructive, but the mark-to-market increases that we've seen in many prices really since 2021 has not gone away. And we do see that in the Michigan surveys. We see sentiment has been low now for 2 years straight, and at the same time, the recent Michigan sentiment numbers have expressed concern in terms of inflation expectations moving forward. Rate cuts, we're back at it, 100 basis points of cuts priced into the curve. Look, it is a little different this time. It's one thing to have a terminal Fed funds rate priced at 3 or 3.5% and then have 100 basis points of cuts on top of that. Here, with the Fed likely done at peak, near peak, it seems like they're done. Certainly the ability for the market to price in rate cuts from here is a lot different, and it certainly lends itself, we think, to watching the data really closely going forward. A lot of people now are back on point here with regard to rate cuts, saying we could see rate cuts by March of 2024. But we've heard this story before. We heard rate cuts were coming in July of this year, September of this year, and they just haven't amounted to what the market has requested here in terms of these cuts that are priced into the marketplace. At the end of the day, we need a reason. We need a reason for the Fed to cut rates. Certainly something could break, or certainly something could lend itself for the Fed to be called into action here. But the use of the 13.3 programs earlier this year, we believe, was very indicative of where the Fed's head is at in terms of rate cuts in 2024. And then lastly, what are we watching here? We're watching continuing claims very closely. We posted over the weekend, continuing claims, it's a leading indicator. They've been ticking up, and we're right around levels that we saw earlier in the year, right before the Fed started to expand the balance sheet again off the banking issues. We're watching continuing claims really closely here, and we do believe in terms of the rate market, in particular, the short end of the yield curve should show a very strong sensitivity to these continuing claims as we move forward in 2023 and into 2024. Wishing everyone a great week ahead. Wishing everyone a very happy Thanksgiving. I'm Greg Faranello. I'm head of U.S. rates for AmeriVet Securities.